USDA Rural Development Loans. What is it? How can you use it? So let's first explain what USDA Development Loans are. So there's two types of USDA loans that we're going to go over in this, but for the purposes of just defining a USDA loan, it's a loan that you can utilize between moderate to low to very low income in rural eligible areas. So for Southern California, a great example would be Lake Arrowhead or Big Bear is going to have a lot of USDA eligible properties. So that's number one. There's a little website, you could Google it. It's USDA property eligibility. You could put in the property address and literally as simple as this is eligible or ineligible. So number two, there are two types of paths that you can take with USDA loans. One of them is the USDA Direct Loan, and the other one is a USDA Guarantee. So we're going to kind of go back and forth with both of those. So let's start with the USDA Direct Loan. So the first thing you need to know about this is all USDA loans will publish their income, meaning just like you go on the website and do the USDA eligibility, the property eligibility, where it's income eligibility. And in the website, you'll pick your state, California, your county, Riverside County, and then it'll ask you a series of questions. Some of those questions are there any students in the house? Are there any military in the house? Or is there anybody disabled in the house? And you fill in not only those questions, but you also fill in the household income. So USDA is huge on household income. So now for the direct loan path, this is for low and very low income. So I think low income is right around the $70,000 range in Riverside and San Bernardino counties, whereas the very low income is about $46,000. So this type of loan with the direct loan path, you go directly to USDA. You don't contact someone like me to help you facilitate the loan. You go directly to USDA. Now, these loans are done over a span of 33 to 38 years. A traditional mortgage, you have to repay it over 30 years. The USDA Direct pushes that out a little bit longer. Also with the direct loan, USDA sets the interest rate, and it's usually lower than the market rate. As of today, now we're in January 2024 when I recorded this, the USDA rate is in the low fives. I believe it is 5.125%. So that's the great thing about them is, again, they set the interest rate, it's amortized that repayment period for 33 to 38 years, and this particular loan product, if you fall within the low and the very low category of income, which I would check online, is you go to USDA Direct. Now there's going to be a lot more little benefits that you get from Direct, but let me go over to the guarantee side. Now the USDA Guarantee is when you'd get someone like me involved. So it's for moderate income. So again, right on the website, you type in Google USDA income eligibility. To give you some context, for Riverside County, all USDA loans guarantee are 115% of the average income in the area. So I believe in Riverside and San Bernardino County, you don't want to go over 111,000 is your income. So you're capped there, that's number one. Number two, USDA doesn't set the rate, it's market rate. And so the rates right now are between high fives and low 6%. So we're still doing great there. Number three, it's 100% financing. Don't get that confused with zero down. It's covering all of your down payment, which is excellent. And number four, with the guarantee loans, with the direct loans, they could take longer to close. There's a lot more nuances in it. So they could take 45 to 60 days to close, where the USDA guarantee side, it takes about 30 days to close. So it's just like a normal transaction there. Now, the one thing I have to emphasize again, and I can't emphasize this enough, is it's really based on household income. So if you're, let's say for instance, in my house, it's myself and my husband. My oldest son just moved out. He just graduated college, but let's say he still lived with me and was planning on living with me, which a lot of college graduates are doing just to save up money to be able to buy in California. Well, yes, I would be purchasing the house for my husband and I, but also for my children. And even though my oldest is my child, it's still a grown adult. He's still making a salary. I would have to include his income, which would then make it so I don't qualify. So that's huge. Whether you're doing the moderate income, the guarantee program, or the direct, it's household income. Now, on top of that, One of the things that I love about USDA is the credit side of things. Now, there's no set credit score. So let's say if this were an FHA loan or a conventional loan, FHA is a 580 credit score, whereas a conventional is a 620 credit score. USDA, that doesn't really matter. You just have to prove that you pay your bills. So what do I mean by that? Yeah, a credit score would prove it. So if you have a 620 credit score, high five. But let's say you have no credit at all. Well, I would ask for utility bills. I would ask for cell phone statements. And if we can prove that you're paying your bills on time, then you're eligible for this loan. Now, the other thing with the direct loan is you have to prove that you're not in safe and sanitary living. Meaning they really want individuals to be able to purchase a USDA going direct with very little down, where they're subsidizing the payment on the direct loans as long as you're not safe where you're at. They want to get you in a nice and healthy environment. So with these direct loans, you definitely have to jump through more hoops. You definitely have a lot more proving to do, but sometimes they subsidize your payment a little bit more too. So instead of, not only do they extend out how long it takes for you to repay it, but they also give you a lesser interest rate, and sometimes they even go one step further and subsidize that payment. So I love the direct loans. Now let's go back to the guarantee side. This is a side that I really deal with the most and I know the most about. So we talked about it's a normal 30-year mortgage. We talked about that it's 100% financing or 100% down payment, but not 100% cash out of pocket. We talked about that it's the market rate. We talked about your income, that you have to be eligible for the area income. Now let's talk about some of the property requirements outside of the rural area. One of the bigger property requirements is it can't be an income producing property, meaning it can't have an ADU on it to actually give you and offset your payment. It can't be farmland. There can be no income producing. There's a whole separate loan for that. So no income producing. Number two, about the property. USDA really cares about health and safety. So what does that mean? You can't have chipped or peeling paint. You have to have heat. You have to have a water heater double strapped. You have to have smoke detectors. The home has to be in good condition. The other side of the guarantee loan, we talked about the credit, we talked about the property, is the income eligibility. So with the direct loan, it's your income eligibility, they review it, but they're gonna give you a lot of leniency. They're gonna have you prove certain things, where the guarantee loan, it's very specific. So first of all, you have to have a 2-year work history. That's number one. So the 2-year work history, yes, you can have some gaps in it. You can bounce around a couple of jobs. So we just have to prove in the last 5 years that you've been consistently working and making a paycheck for the last 2 years. If you're self-employed, it's a little bit different. If you're self-employed, we have to have 2 years worth of tax returns. And if you wrote off too much money, then we're probably gonna have a problem qualifying. So on the guarantee side, we always look at ratios. They're called debt to income ratios. So the first one is a housing expense, and this is what it looks like. It is your proposed payment divided by your gross income. And so what USDA guarantee says is that housing expense can't be more than 29%. So let me give you an example. You make $10,000 gross a month, and your mortgage payment can't be more than 29% of that. So that's a $2,900 mortgage payment. So that's one of the first things that I'm going to look at, is just to make sure we're meeting the housing expense. The other thing is, if you are doing 0% down, the other ratio that I as a lender have to look at, it's called your debt to income ratio. And what that is again, it's a housing expense plus the minimum payments that we see on your credit report divided by your gross income. So let's say the housing expense is, I don't know, $3,000. That's your proposed payment is $3,000. Plus you have $1,000 in credit card expenses. So that's $4,000 divided by your gross income of $10,000. So that'd be a 40% debt to income. Well, I can go up to 41%. So we check that off the box. So that's one of the bigger things, is if you are putting 0% down, they want to see that housing expense under 41%. Now, there are a few little tips and tricks that I want to talk about with this loan outside of qualifying. Yes, there's probably 55 pages of guidelines that we have to do to qualify, but those are some of the good ones to keep note of. But number one, I've told you a couple of times, it's 0% down, meaning your down payment. closing costs are going to be 3 to 4%. So where is that money coming from if you don't have it? Well, a couple of things. One, you can get a seller concession, a seller credit, 6% of the purchase price. So if you're buying a $300,000 house, 6% is $18,000. So you could get the seller to really cover every bit of your closing costs. Number two, if you don't have the money, let's say my son goes to buy a house and he's getting the USDA loan where he has put zero down, but he's still got those closing costs, I, as his mom, can gift him the money. So you could get gift funds for the rest of the money. And then lastly, which is super cool, one of the cool things about USDA is if the appraised value comes in higher than the purchase price, again, you bought for $300,000, it appraises for $325,000, that's what the appraiser is saying the home is worth, then you can finance some of those closing costs. So USDA is one of the only loans out there that you get to finance those closing costs in it. So 3 ways where you don't have to pay for the closing costs. And the next thing that I really want you to be aware of, you're walking into a property with 0% down, meaning if you're looking to sell the home in a year, you're probably not going to have enough equity to sell it. So please factor that in when you're doing this type of loan. That in California, our property values are a little bit higher. And for the first 5 years of loan, when you're making those mortgage payments, a lot of it is going to interest. So you probably want to live in this property for at least 7 years so you can amass enough equity where it makes sense to sell it. So that has to be a huge factor in if a USDA loan is right for your family. Now, of course, there's particular scenarios, so if you have any questions for me at all, let me know your scenario, definitely comment, and I'll go through to see if your scenario works for a USDA loan and if it's the right loan for you. Thanks for watching.